Hello, everyone, and welcome to another episode of UBS Road to the Election, an Election Watch series. Please join me in welcoming today's guest, Bob DiMella, co-head of MacKay Municipal Managers and portfolio manager of the NYLI MacKay Municipal Bond Funds. Bob, thank you for joining us.
Thank you for having me today.
I'm imagining, and the reason why we asked you to come in today is because when you think about municipal bonds, and especially municipal bond investors, I'm sure they have a lot of questions about what the next 4 years may potentially look like, depending on who's sitting in the White House when it comes to tax exemption and, of course, the SALT deductions that we talk about constantly since the 2017 ruling went into place. But let me just start with you. If you think about the Muni tax exemption as it stands, is there any risk to it given whether or not we have Vice President Harris in the White House or former President Trump? What are your thoughts on that?
Yeah, there's always a risk to it, right? Because it's a line item. It's something that is perceived to be easy to go after, right? You're only going after the wealthy in the country, which is a misconception, by the way. Many just average people in this country own municipal bonds. They like it. And so you always will bring it up. We don't think it's a high probability it's going to get overturned for a couple of different reasons. First of all, these are state and local governments, municipalities that are funding the shared services and infrastructure in the country. They need lower financing. If their financing goes up, the taxes on the backside, the fees that they have to charge on the backside have to go up. No politician wants to have that going through. In addition to that, there's a reciprocation right now between treasuries and municipals. If the federal government says, well, municipals are now taxable, states can actually tax treasury bonds. And treasuries have a lot more debt than the municipal marketplace does. So for a couple of those different reasons, we don't think it's a significant, great risk of actually getting overturned, but it is a topic that you will hear about without question.
Yeah, because it looks like there are trillions of dollars that are set to, in tax exemptions, that are set to expire at the end of 2025, which we've been talking about here in our studio for quite some time. That poses a little bit of a risk. Maybe could you expect to see maybe some volatility in the muni market given that fact?
You'll see some of it. There's a lot of different changes. You brought up the SALT deduction before, right? That was a $1.2 trillion line item. It's set to expire. That is, the cap expires at the end of 2025. And so therefore, you really have to think about how you're going to fund all of these different changes going forward. Tax-exempt nature. That's only around $40 billion a year to the federal government. When you're talking about $34 trillion of debt, actually 35 today, and you're talking about the size of the federal deficit, that doesn't really help a whole heck of a lot when you're going after those type of line items.
Right. And it's interesting when we've been looking at the muni market, and this is what you do every single day of your life, we've seen the yields really go up higher and higher. Do you think that's because of the supply, that there's this oversupply out there, or is it just the fact that people are kind of looking at or expecting maybe what the Fed is going to start doing? As we sit here, we expect the Fed's going to cut probably 200 basis points between now and next December 2025.
So you bring up a really great point. What specifically happened over the last 2 years was an absolute reset of income levels, right? Yields in the marketplace. From being really, really low for about 15 years after the great financial crisis, when in that time period, from an investor perspective, it was really hard to attain an attractive income stream.
Right.
Today, a lot easier, and so that's what we're advising clients to do. Take advantage of it. So it really started in 2022. Right now, on a temporary basis, we absolutely are having an increase in supply in the municipal marketplace. That is directly tied because of the election. You see this every single year, especially when you're going through a presidential election cycle. Issuance gets front-loaded before the election date, and then it drops off significantly right after. And so, yes, we're advising clients to take advantage of the increase right now, the relative value of the municipal marketplace, the income dollars that you can generate, because the technicals, i.e. the demand is going to be stronger than the supply when you're going into the end of the year, and that should support the entire municipal marketplace.
Yeah, it's talk about an interesting time for munis and something that you've been doing for your career. I'm sure this has been such like an historic time within the muni space.
Yeah, we're looking at weekly issuance in excess of $15 billion.
Incredible.
That is very rare for our marketplace.
Right.
And so we believe it's going to continue. through most of October right now. And it's weighing a little bit on the municipal marketplace. You know, it's one of the measures from a relative value perspective they always utilize is ratios, right? AAA rated munis over AAA rated treasuries, right? Because we're tax exempt, the ratio is supposed to be below 100%. We're at the long end of the yield curve. We're getting closer to 90% right now. That's showing a lot of compelling value, and it's that supply picture that's kind of doing it right now.
Right.
I don't think it's so much the risk of what taxes are going to do as much, but on the margin, that could come into play, especially if corporate taxes could change, either going up or going down. Higher corporate taxes mean the crossover buyers, the banks and the insurance companies will come back into the municipal marketplace because it's more advantageous for their portfolios to have municipal bonds again.
Right, makes sense because you get those tax exemptions. Let's go back to SALT for a second, which for the audience is the state and local tax deductions that the Tax Cuts and Jobs Act in 2017 put a cap on of $10,000. Now, look, to be honest, it really does mostly, I think, by a higher percentage affect more higher income states like California, New York, New Jersey, Connecticut. We're residents of two out of those 4 states.
Correct.
But there has been some discussion now recently on the campaign trail. Trump himself said he might roll those back, while Harris has not really made any comments about the Trump-era tax cuts, but said it won't affect anybody who makes less than $400,000 a year. But what are your thoughts on SALT, and does that really impact, when we're looking at the muni markets, how does that kind of play in that picture?
It doesn't necessarily directly impact the demand in the municipal marketplace as much. It is a big line item, without question. When it was first put into place, there was a lot of anger over it, right? Because it was specifically geared toward just those high tax states. And it's one of the reasons why Senator Schumer in New York is trying to push to raise it. Probably a more reasonable approach would be moving the cap from 10,000 to say 25,000. You're going to help most constituents instead of bringing back the cap in full.
Right.
And so there's probably going to be a little bit of a balance there, but there's a lot of elected officials in certain states that have told their constituents, I'm going to fight to bring it back. So I expect something to be done in the future.
Yeah.
Either party, by the way.
And it seems like it's in everyone's best interests.
Donald Trump just mentioned it yesterday that he wants to bring it back.
Right.
And so that was a bit of a surprise because it was his
administration that put it into place.
Put it into place.
Right.
But you can see how the landscape in the marketplace is kind of changing with the sentiment of what it really does and what they need to do to help alleviate tax burdens on clients, but also the deficits at the end of the day.
So I don't think this comes as a surprise to anyone watching this show, but inflation, meaning the economy, is really the most important thing that voters have been saying is what they're going in to vote on. Inflation being one of the biggest topics there. And as we said, we're expecting the Federal Reserve, to start cutting rates. But what kind of impact does inflation, and it's cooling at this point. We had a 2.5% print on CPI recently, so we're seeing that it's cooling and maybe leveling off a little bit. We're getting closer to that Fed target of 2%, which even Powell himself said may not be completely attainable. But how does that affect the individual municipalities when you look at inflation?
So this is interesting, and we wrote about it in our insights a couple of years ago, because inflation for a fixed income asset class is normally a big problem. And we kind of told clients, we're like, well, actually, the municipal marketplace has a bit of an inflation hedge embedded in it. And a lot of clients looked at us like, what are you talking about? It's a bond, right?
Right.
Fixed income bond math works again. However, if you think about the revenue streams coming into the state and local governments, they're nominally based. They're not real based. Sales tax collections, property taxes are all nominally based. So as inflation goes up, so do cash flows. And you saw this over the last couple of years, that the revenue collections at many state and local governments actually continue to increase and continue to be very, very strong. We have had several years in a row where upgrades are far outpacing downgrades, slowing down without question this year, but they're still outpacing on an upgrade to downgrade basis. And so unlike corporations with corporate bonds, higher inflation don't necessarily mean the worst case situation. However, Inflation too high, if it curtails economic activity, then it will have an impact on it. But we actually saw, quite honestly, the reverse over the last several years with the inflation that we actually witnessed.
Right. Listen, everybody loves a Goldilocks scenario. When it's just right, it almost seems that in what you just described, that scenario is kind of really the sweet spot, at least for in this environment for munis.
Right.
Yeah.
Exactly. The sweet spot in the municipal marketplace, and not necessarily just looking at inflation, but thinking about economic activity. The municipal marketplace is not the stock market. We don't need a ripping economy. We just want a slowly growing economy. Municipalities, state and local governments have a lot of different levers and tools at their disposal to balance their budgets. This is one of the reasons why the fundamental credit of the municipal marketplace is so resilient, even under times of recession. Now, hard recessions, like the great financial crisis, cause some pain, without question. And state and local governments had to really retrench back then. But short of that, even a mild recession, there's a lot of tools at their advantage to it. And this is why the resiliency of the municipal marketplace from a credit perspective is so strong. And that's what clients should think about when they're thinking about a diversified fixed income portfolio.
Great. So Bob, let's take it home from here. Not only do we have the election, which is what this show is really about, but there's a lot of uncertainty around it. It's still an extremely tight race, and we're just less than 50 days away from Election Day, but early voting has already begun in some states. We do have a Fed that's going to be cutting rates. We have inflation that's cooling. A soft landing scenario is still what our CIO expects. And actually, our CIO right now recommends 7 to 12-year maturities and a portfolio target effective duration of 5 years. What are your recommendations for muni investors given all of that and what the expectations are and the uncertainties that are surrounding everything we're talking about?
So we do like the relative value of the municipal marketplace. One of the things that we've been talking to clients about, in addition to like the credit allocation, right? And we have been slightly overweight high yield as an example from the value, and that's coming down slightly. Yield curve perspective, you talked about the yield curve. We have not liked 5 to 10-year bonds for several years now. That has been a very rich part of the municipal marketplace. It's rich because a lot of clients were investing in it.
Right, right.
However, that changed this year. So now, if you look at the shape of the municipal yield curve from, say, 5 years on out, it looks normal to us for the first time in a long time. Inside of 5 years is still subject to what the Federal Reserve is doing, and it's going to take some time for that to renormalize. So what we've been trying to advise clients to do, and it hasn't been easy, by the way, is try to get them to extend their durations, extend their maturities, lock in some of these yields while they can. Now, many clients are thinking, well, I'm just going to ride this short Treasury yield curve wave as long as I can, and we're saying that's great for now and it's very attractive, and to be overweight cash on a relative basis makes sense because of the attractive nature of it, but start extending out, because when the Federal Reserve starts moving, the short end of the marketplace is going to move much faster.
That's right.
And then when you're trying to lock it out, you're going to be at much lower yields. And so the durability of income is the way we're talking to clients about it, is very, very important. So we would actually recommend they start extending out the yield curve.
Thank you. Thanks, Bob. And we're already seeing, even with expectations of the Fed and recent data, the 2-year treasuries are starting to become lower in the yield than the 10-year counterparts, which, of course, we know. We've been in an inverted yield curve for 2 years, and finally it's sort of de-inverted temporarily at least. So interesting times for investors, but thanks for your insights, Bob. Great to have you here in the studio with us.
Thanks for having me today.
Of course, Bob DiMella, again, from MacKay Municipal Managers and portfolio manager of the NYLI MacKay Municipal Bond Funds. And thank you all for watching the show. For more information on everything we talk about in this series, visit our website at ubs.com/election watch. There's lots of other episodes in this series there, plus all of the election-related content from our best partners and our own Chief Investment Office here at UBS. And we also encourage you to continue this conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody.